Hello people, a very good morning to all of you. So guys, here we begin our first class for the CA Foundation November 2022 attempt. So guys, the first chapter that we're going to discuss is accounting for bills of exchange, right? So guys, what will you learn from this chapter? In this chapter, you'll understand what is the meaning of bill of exchange and what is the meaning of promissory note. Second, we'll try and understand how do we calculate the due dates. Now you may ask, sir, what due date? Why are we calculating? Everything you'll get to know when I do start doing the practical questions. Accounting for 4 cases. What will happen if the bill is retained till the date of maturity? What is the accounting treatment when bill is discounted with bank? What is the accounting treatment when the bill is endorsed to the third party like creditor? What will be the accounting entry if the bill is sent to the bank for collection? Right? So this you will be learning. And accounting for dishonorment of bill. So in the above 4 cases, if the bill is getting dishonored, what is the dishonorment entry? And then finally, accounting for renewal of bill, accounting for retirement of bill. From point 1 to point 6, guys, this is something which we have already studied in detail in the 11th standard. So I'll be doing a quick recap of that, and then I'll be heading towards the numerical questions of these concepts. And then finally, guys, the new concept that you're going to learn here in CA Foundation is accounting for accommodation of bill. In 11 CBC, guys, we had just a 2-line theory of what is the meaning of accommodation of bill. Here you'll get to see complete practical questions, lot of numerical questions based on this particular concept, right? So if you're ready, I'll start with the session. All set? Wonderful. Your bills of exchange and promissory note comes as a part of your accounting for special transactions. So under this category, this is the first unit that we are going to discuss. Let's quickly have a glance, guys, that in the past examinations from this chapter, how many questions were asked and for how many marks. If you look at May 18th, so May 18th was your first attempt for your CA Foundation as discussed in the introductory video. May 18, there was no question asked from bills of exchange. November 18, no question from bills of exchange. But in May 19, we had a question of 5 marks coming from this chapter. And then in November 19, there was no questions from this chapter. December 2020, there was a 10-mark question coming from this chapter. All of you knew that after November 19, the next examination is supposed to be May 2020. But because of COVID, that attempt got cancelled and we had December 20 attempt coming directly. So in that attempt, the question of 10 marks was asked from this particular chapter. And then Jan 21, July 21, no questions from this chapter. In December 21, it was again asked for 10 marks. Now, students will write in June 22, probably 2 weeks down the line. So in that question paper, we'll get to know if there is any question from bills of exchange asked or not asked. So like this, guys, I'll give you an analysis before we start every chapter so that you understand what is the weightage, what kind of questions they are asking. This doesn't mean that you will take a trend. For example, first 2 attempts, no question. Then third attempt question came. Then 1 attempt gone. Then another attempt they asked. So don't try to speculate any pattern. That will not work. If you do that, IC will say judge me and I'll prove you wrong. Right? So we have to do all the chapters. This is only for your knowledge to understand in which attempt for how many marks they've asked and what kind of questions they've asked. This is only for analysis purpose. So like this, I'll also give you analysis like this. If you see, this is completely May 18 attempt, paper. So in that question paper, each question had come from which chapter, what is the marking and weightage, everything I'll give in detail. I'll be sharing with all of you. So this should help you to analyze and get an overall idea. How do you approach which chapter should be given first preference and it should be given second and so on. Am I clear with what I'm talking? Wonderful. So let's start the topic, guys. Guys, in India, if you're supposed to do any business, can I say you can either deal with goods or you can deal with services? Am I correct? Online people, am I correct?
Yes, sir.
You can deal with either goods or you can deal with either services. Now, guys, normally when you are selling the goods, that is called as a business financial transaction, correct? In accounts, I'm concerned with business financial transaction. If you remember the first class of 11th standard, we studied that What is accounting? Accounting is a systematic process of identifying of what? A business financial transaction. Business financial transaction. Transaction means any activity that takes place between two people. Finance means that transaction should involve money or money's worth. Means what? If I'm selling laptop, you should give me money in return. Or if I'm selling laptop, in return you have to give me phone. Goods for goods exchange, right? Barter system. So something has to be there as a consideration. That is called as finance. And this transaction should take place in business. If I go out there in theater and buy a popcorn, that is a financial transaction because that is happening between me and the cinema owner or cinema theater, and it is involving money. But that is a personal transaction. So we'll not capture that. So we need to identify a business financial transaction, first step. Then you'll measure in terms of money because I want to record things in monetary value in my accounts. And then you will record in form of journal entry. Then you will classify it in your ledger. Then you will summarize in your trial balance, P&L, balance sheet. Then you will analyze and interpret the information. And then finally, you will communicate those information to the users of the financial statement. Am I right? So I'm talking about transactions. So there are two types of transactions. There are two types of transactions. One is cash transaction, another is credit transaction. All of you know what is a cash transaction? One is cash transaction, second is credit transaction. What do you mean by cash transaction? So let's suppose this is seller X. Seller has sold goods to buyer and buyer is Y. So seller is selling goods to the buyer. In return, buyer is paying you the money in form of cash or bank. So basically the payment is happening. Correct? Now this we called as a cash transaction because immediately when you sell the goods, in return you're getting the payment either in form of cash or bank. When I say cash transaction, it does not mean only money is coming in cash. On the spot, if I get money in whatever form, that is called as a cash transaction. Even if I get a check, that is called as a cash transaction. If you remember when we did the subsidiary book, we have something called as cash book. In cash book, you have cash column and bank column. So in cash book, we should have only cash column. No? If cash meant only cash, then you should have only cash column. Why do we have bank column? Here, cash transaction or cash book means that both cash and bank. So here, the moment I'm selling the goods, the moment the buyer is making the payment, the relationship is over, the contract is over. In credit transaction, what happens is that this is the seller, sells goods to buyer. This is X, this is Y. Seller is selling goods to the buyer. In return, the buyer is not making the payment. In return, the buyer is not making the payment. He's saying that I'll give you the payment after a few days. And that X very well knows Y. X knows Y from very long time. So Y says that, you know me for a very long time. So I'll make you the payment a little bit later because currently I'm running short of cash. So X understands his position. He said that no problem. Right? This is called as a credit transaction. In this case, what happens? The seller will become, can I say, creditor for buyer's point of view, because buyer has to make the payment to the creditor. So from buyer's point of view, can I say the seller is creditor? And from seller's point of view, this buyer is nothing but a customer, correct? From the seller point of view, the buyer is a customer. From customer, if you have to receive any money, that person is called as a debtor. Now, your bills of exchange, is coming into picture not from cash transaction. It is coming into picture by virtue of credit transaction. Now, in future, whenever this party makes the payment, he can make the payment in form of cash. He can make the payment in form of check. He can make the payment in any other form, such as I'm exchanging goods for goods, barter. He can make payment in form of goods. And the last option is he can make the payment through bill of exchange or a promissory note. So bill of exchange and promissory note is a document which is used or referred for making the future payment. This will come into picture. Your bill of exchange or promissory note comes into the picture, or the birth of this, particular concept happens only because of credit transaction, because the contract is still pending. In cash transaction, what happens? I sell the goods, you give me the money, relationship is over, contract is over. But in credit transaction, I've only sold you the goods, you have not given me the money. The contract still prevails. And you say that we'll make the payment at the later date. By that virtue, this concept of bills of exchange and promissory note comes into the picture. Now we need to understand what is the meaning of bills of exchange and a promissory note. Now, seller and vendor. Seller is called as vendor. This person sells goods on credit to the buyer, to the customer. Along with the goods, can I say he will send the invoice also to the customer? Correct, no? So this invoice from the seller's point of view is the sales invoice. And for buyer, it is a purchase invoice. Correct. Now what happens is that the seller knows this customer very well. So customer asks that, sir, you know me from a very long time. I'm running short of cash. So I want to buy this product from you, but I'm running short of cash. So please give me the goods on credit. Now seller has seen this customer for a very long time. He said that no problem. You take the goods. So now what happens is the moment the sale has happened, the entry that you pass is debtor account debit to sales. Am I right? Debtor account debit to sales. Now guys, in this throughout your CA Foundation journey, we'll be continuously and constantly using only the modern approach. Modern approach is what? Asset, liability, capital, expense, income, increase method, decrease method, that we'll be focusing on. Okay. Now guys, debtor, why have we debited? Because debtor is asset. Why debtor is asset? Asset means something you own it, or asset means something you expect to receive in future. So can I say from debtor you're expecting money to come in future? So by that virtue, here your asset balance increases. To increase the asset balance, I need to give a debit. So debtor is debit. Sale is my income. Income is credit balance. To increase my income, I need to give a credit. So this debtor to sales. This is recorded when the goods is being sold and when the invoice has been given to the customer. Now what happens is that after a few days, the seller goes and asks customer, give me my money. The customer says that, oh, I'm a little bit, again in tight position, I'll give it tomorrow. Tomorrow this fellow again goes, he says that, no, I'll give it day after tomorrow. Like that, every time the seller goes and asks for the payment, this customer is, telling come today, come day after tomorrow, come after 1 week. Now, what will be the mentality of that seller? Will he not get scared? Hello, come on. When see, you agreed a particular date that you'll pay, but on that date you're not paying, and you're asking him to come 10 times, here and there. So obviously anybody would get annoyed and he would get scared. So now the seller started getting very bad dreams in his night while sleeping. So now he's worried that what if this fellow doesn't pay? What if one day this customer say, get lost, I'm not going to make you the payment? What will he do? The probability is there, yes or no? That is when this particular seller goes to the customer next day and tells that, see boss, you've been asking me to come to and fro for so many days. So this is too much. Now you tell me one date and promise me that on that date you will make me the payment. This customer is again very intelligent. Oh, now if I give promise in writing, that becomes a contract and I'll be forced to make the payment on that particular date. So this fellow tries to somehow avoid that also. So what did seller do? Seller asked the customer, please give me a promise in writing that on this particular date, this much amount you'll pay. So this customer started avoiding that also. He says, okay, I'll prepare the document, give it to you today. I'll prepare the document and give it to you tomorrow. Like that, for preparing the document, he kept on delaying. Now the seller thinks that this doesn't work out. Let's do one thing. Let me prepare this document on customer's behalf. So now seller is going to document that this customer has purchased goods on so and so date from so and so person for so and so amount. And on this particular date, he is supposed to make me the payment. He will draft all the content and this content will be sent to the customer. Tell me one thing. If the seller is preparing a bill of exchange, a document or a promise in writing, will it be binding upon the customer? For example, I tell you that I make a piece of paper. In the piece of paper, I tell that, okay, Saraswat has to pay me 1 lakh rupees on this particular date for taking CA Foundation coaching. The moment I create this document, is Saraswat liable to pay me the money? Like that, then any Tom, Dick and Harry will create any document. No? So when you study your law, you'll come across Contract Act. in your law subject. So Contract Act says that there should be an offer. So here the vendor is giving an offer to the customer by preparing the document. Now the customer has to accept it. Okay, I'm accepting that I'll pay you this much amount on so and so date. Acceptance alone is not sufficient. He will sign and keep the document with himself. What is the use? So the third step is that the acceptance needs to be communicated, which means the first step is the seller will prepare the bill of exchange, having all the details that on what date this fellow has purchased the goods, what value he has purchased, when will he make the payment, everything is being captured in this document, and he will send this document to the customer. Customer has to accept, and within a specific period, he has to give his acceptance back to the seller and vendor. So the first step is selling the goods on credit. Now, the seller draws a bill of exchange on customer because we are tired of asking the customer to give promise in writing. Since he did not give the promise in writing, now we are preparing that promise note. On whose behalf? On customer's behalf. The process of preparing the document by the seller and accepting by the customer is called as bills of exchange. In a bill of exchange, seller will draw the bill. Draw means what? Make the bill. Make the bill means what? Create the bill or write the bill. Bill means what? All the terms and conditions. So therefore, the seller is called as the drawer of the bill, or is called as the maker of the bill. This bill is drawing on behalf of the customer, for the customer, and this person will be called as a drawee. The person who is creating the bill is called as a drawer. The person for whom the bill is being created is called as a drawee, and this person has to accept it. So this fellow is called as an acceptor. Who's going to accept here? Customer is going to accept here. So customer is called as an acceptor. In this entire journey, guys, who is going to make the payment to whom? Buyer or customer will make the payment to the seller. So can I say he'll be the payer? Payer is the person who pays the money, and the person who receives the money is called as a payee. Correct? From seller point of view, this fellow is, buyer is a debtor. In seller's book, in my book, you are my debtor. In your book, I am your creditor. So from buyer's point of view, seller is a creditor. From seller's point of view, buyer is a debtor. Customer is a debtor. Debtor is customer, right? The person who is issuing or writing the bill is also called as an issuer. The person to whom the bill is written is called as an issuee. Are you clear with the terms? So this term, they can ask you in true and false. In the concept of bill of exchange, seller will be the drawee, true or false? Seller will be the drawee, true or false? False. So now you're able to understand why I'm going with this concept. So in bill of exchange, one person, that is seller, will draw the bill on customer, and the customer is ought to accept it, and he has to send that acceptance back to the seller. So finally, who is the holder of the bill? Seller is having the possession of the bill. Why? Because tomorrow if that fellow doesn't make the payment, this will be acting as an evidence, and you will take him to the court of law and try to recover the money. Therefore, this evidence has to be in hands of the seller only. This process is called as a bill of exchange. Please tell me if you have any doubts. Then I'll go forward. Online people are able to follow?
Yes,
Kavi,
sir.
Kavi,
Yes, sir.
Kavya,
Yes, sir.
Kavya, Shrikant, Yash.
Yes, sir.
Yes, sir.
Okay. A bill of exchange is an instrument in writing. So can I say that whatever we prepared, the document is in writing? So number one, it is an instrument in writing. Second, it contains an unconditional order. In the document, we will not request, please make me the payment. Can you please make me the payment? Will not. You have to make the payment on this date. It's an unconditional order. We are giving order to whom? Customer, that he has to pay. And that order is unconditional. Unconditional means what? The opposite customer cannot put a condition that I'll make you the payment, but you should do this, but you should do that. That condition he cannot place. So this is an unconditional order. Who's giving the order? Seller is giving an order to the buyer, and buyer cannot put any condition. Second, it is an unconditional order. Third, it has to be signed by the maker. Who is the maker here? Seller is the maker. So he has to sign. Why is he signing? Because he is preparing the bill of exchange. No? So I need to know who has prepared. The person who has prepared the document, he has to sign it. So it has to be signed by the maker. Directing a certain person Directing a certain person. Certain means what? The person who has to make the payment, that person's name you have to certainly mention. Certainly means what? Surely. You have to mention the person's name. Directing, you're asking certain person. Here, who is that certain person? Customer. So you're asking customer. So this is point number 4. You have to mention the customer's name, that Mr. Y will pay. Or on behalf of Mr. Y, somebody else will pay. So whoever is going to make the payment, that person's name has to be captured. So directing certain person to pay certain sum of money. Certain sum means what? You have to mention the amount that needs to be paid. You cannot say that this fellow has to make me the payment on 20th of July. You have to tell that this fellow has to pay 10,000 rupees on 20th of July. So you have to mention the name of amount of money. Sorry, you have to mention the amount of money. Certain means absolute value of the money has to be mentioned. The amount has to be mentioned in both numbers and in figures. If you have ever seen a checkbook, you will write the numbers both in, the amount will be written in both numbers. 1 lakh, and again will be written in words. 1 lakh. Why? Because what if somebody makes this one more zero of that here? So always in number and in word, it has to be both there. In same way here also, whatever amount you mention, it has to be mentioned in both numbers and the wordings. Directing a certain person to pay a certain sum. 5th point is certain sum of money only to make this payment to seller, or seller may say that don't make this payment to me. I have to make one payment to some other person. No, you make the payment to him directly. So only to, or to the order of a certain person to whom the payment should go, that information also should be there. So this is point number 6. Or to the bearer of the instrument, make the payment to seller, or make the payment, seller will say that make this payment to Mr. A. So I have to mention the person whose name, who's going to collect the money. If seller is going to collect the money, seller's name should be there. On behalf of seller, if anybody else is collecting the money, that person's name should be there. Or you can simply mention, if you don't know whom to make the payment, whoever is finally having that bill, whoever is going and presenting that bill to the customer, the bearer of the bill. Bearer means what? Holder of the bill. Whoever is holding the instrument, make the payment to that person. If that point is mentioned, if the bearer of the instrument should get the payment, like that, if the wording is given, the person whoever is having the bill, he will get the money. For example, I gave this bill to Saraswat. So Saraswat has to come and give this bill to me. Only I'll pay this to Saraswat. Now on the way, Saraswat dropped this bill. Arjun got that bill. And Arjun is coming with that bill to me. So will I make payment to Saraswat or will I make payment to Arjun? I'll make the payment to Arjun. Why? Because he is bearer of the instrument. In the bill of exchange document, the wording is give the payment to the bearer of the instrument, which means what? Whoever is having the bill in his hand, you pay him. That is very risky. If you don't want to have this risk, in that case, you can mention the person's name. In the document, if it is mentioned that make this payment to Saraswat, and if Arjun is going and taking the bill, the customer will not pay the money because he will ask for the bill of exchange document and the Aadhaar card. And see in the bill of exchange, whatever the name is there, whether the same name is there in Aadhaar card or not. And then only make the payment. So this is bills of exchange, guys. Any doubts here, please? Anybody's got any doubts here, please? Hello, online people. I'm waiting for all of you.
Clear, sir.
No, doctor.
Okay. Next is the concept of promissory note. Promissory note, in this case, what happens is seller will sell the goods on credit to the buyer, right? And later, seller got bad dreams that what if this buyer does not make the payment? So he goes to the buyer and says that, please give me a promise in writing that you make me the payment. Here, this buyer is very good. He says that, okay, don't worry, you're having bad dreams. No, I understand. So now the buyer is taking the responsibility of preparing the document. He's preparing this document called as a promissory note. This guy is a genuine guy, good guy. He's not trying to, manipulate. In the previous question, the buyer was a little manipulative. He did not have any intention to give in writing. That is why seller was forced to prepare the document and get it signed from the customer. But in this case, the buyer is a genuine person. So the moment seller requested, give me a writing promise that you'll pay on future date, immediately the buyer agreed and he prepared the document. That document is called as a promissory note. So the person who's drawing the bill or promissory note is called as a drawer or the maker. So here, who's the drawer? Customer, buyer, creditor, whatever be the name. They can ask you a question in the true and false. In case of promissory note, creditor is the drawee of the promissory note. True or false? False, because creditor here is the drawer. I asked a question. In the case of promissory note, creditor is the drawee. Creditor is the drawer. Hello. Who is the drawee? Seller becomes drawee. The person who prepares the document is called as a drawer. The person who is drawing the bill. And to whom the bill has been handed over is called as a drawee. So here the seller becomes drawee. It becomes ulta. I mean, not creditor, debtor. Sorry. Yeah, you're right. Sorry, debtor. So in case of promissory note, debtor is a drawee. False. Because debtor is a drawer. Presence of mind. Good. So, and the seller is called as a creditor, correct? And therefore, this fellow is the drawee. Here, is there any need for acceptance? Was the opposite person, buyer is telling that I'm promising you to pay. Whether this fellow will reject, no, you don't pay me. Is there a need for the seller to accept first of all? If Saraswat comes and tell me, sir, take 10,000 rupees, will I say no? Daily you bring 10,000. What for me? I will not take any acceptance. There is no acceptance. And why will I reject also? So same way, in this question, there is no case of acceptance. There is no need of rejection. So acceptance will not happen in the case of promissory note. So true and false will come. In the case of promissory note, acceptance by the buyer is compulsory. True or false? False. Are you able to understand this point? So acceptance is not required. Who is going to pay here? Payer is going to be the same. Buyer only is going to pay. And who is the payee? Seller. If the payment has been collected by the seller, then seller is the payee. If somebody else is collecting the money, any third party, any other person, then that fellow becomes the payee. Pay means what? The person is collecting the money. Payer is the person who is paying the money. Buyer is called as a debtor, seller is called as a creditor. Who's issuing the bill? Customer, debtor, issuer of the bill. And to whom the bill is issued? To issuee, who is the seller. Promisor, who's the promisor? Buyer is undertaking to promise that I promise you to pay. So who's the promisor? Buyer. Who's the promisee? Seller. Endorsement, I'll come to this little later. So are you clear with what is promissory note? Now, a promissory note is an instrument in writing. Can I say this was written in a piece of paper, document? Okay. It should not be in form of any bank note or any currency note. You cannot create a promissory note on a 500 rupees note. That is not allowed. You cannot touch the Indian currency or any other currency. Okay. Promissory note is an instrument in writing containing an unconditional undertaking. There it was unconditional order. Here, undertaking means what? I am taking the responsibility that I'll make you the payment. I am the promiser. I am the buyer. I am making this promissory note. I am telling that I will promise you to pay. So it is an unconditional undertaking. Undertaking means what? I am taking the responsibility of making the payment. I am taking the responsibility of preparing this document. So this is an unconditional undertaking. Undertaking. Point number 2. A question can be asked in true or false. In the promissory note, the wordings will have that it is an unconditional order. True and false. In promissory note, it is always an unconditional undertaking. Unconditional order is given in bills of exchange. So point number 2 is it is unconditional undertaking. Signed by the maker. Third point is signed by the maker. Who is the maker here? Buyer. To pay a certain sum. Certain sum means you have to mention what amount you're going to pay. If you're going to pay 10,000, record 10,000 in rupees, that is in numbers and in words. So fourth is you have to mention what is that certain sum of money that you'll pay. Only to or to the order of certain person. Only to. I'll make this payment only to seller. Promisor can tell that, boss, I know you only. I'll make you only the payment. I'll not make the payment to anybody. Or if the seller is a very good friend of buyer, then seller will tell, don't make me the payment. I'll tell you one person's name. That fellow you make the payment. So that fellow's name has to be mentioned. Or to the order of certain person. So seller will order him to pay to, let's suppose, B. Then Y has to pay to B. The customer has to pay to B. Or to the order of certain person or to the bearer of instrument. So the payment can happen to 3 people. One only to the seller, 2 to the order of the seller, 3 to the bearer of the instrument. So out of these 3, any one thing only you'll mention. Same thing in bill of exchange also. Bill of exchange, you'll ask to pay this directly to the seller, or seller will order that you pay this to B, or you will say that whoever is bearing this instrument, he will get the money. So in this last three points, any one only have to capture in the document. This is promissory note, guys. Any problem here? Offline people comfortable? Online people comfortable?
Clear, sir.
Yes, sir.
Kavi, Abigail, comfortable? Yash?
Yes.
Yes, sir.
Wonderful. Now, guys, how do we calculate the date of maturity and the due date? Now, what happens is, guys, all of you know what is a check? CHEQU. Then we have something called as DD. DD is called as demand draft. Now, DD has of late lost its importance after we have this all online banking, RTGS, NEFT, IMPS. After that came into picture, DD lost its significance. Then we have bills of exchange and promissory note. Now, this 4 thing, guys, is being governed by a law called as Negotiable Instrument Act. Negotiable Instrument Act 1881. Correct? Negotiable means what? Transferable. Negotiable means transferable. I can transfer. Check, I can give it to somebody else. DD, bills of exchange, promissory note, I can transfer it to anybody else. Instrument means what? Document. Instrument means document. Act means rules and regulations and law. Now, when all this thing was implemented, guys, there was a lot of problem that people faced. In those days, what happened is, in earlier, this is 1881. This is 100+ years old law, which has been amended from time to time. But again, this law is existing since those days. Prior to 1881, when these kind of documents were coming into picture, guys, this bills of exchange is not a new concept. This bills of exchange in earlier days was called as hundi. So hundi system existed even before, prior to 1881, right? So then things have been modernized as per the modern requirement. So this had a lot of problems, inherent problems. A lot of forgeries and fraud was taking place. To take care of that, to keep an eye on the fraud, this act was being passed. This you will understand in detail or learn in detail when you do your CA intermediate. So as long as check is concerned, guys, as long as check is concerned, you mention a date when the check is being drawn. Today, if I'm drawing a check, the date of drawing of check will be there. If I'm issuing a DD, the date of issuing the DD is there. If I'm drawing a bill today, when the bill is drawn, that date is there. If I'm issuing the promissory note, when the promissory note was issued, that date is there. But what is the expiry period of this document? That was not given. So for check, they said that the expiry period is 3 months. So if a check is dated today, within 3 months, if it is not getting cleared, it becomes a stale check. But for bills of exchange and promissory note, there was no such due date given. So here the due date was supposed to be calculated. So what they told that for bills of exchange and promissory note, both put together, the due date that is fixed is 3 months plus 3 grace days. Whenever the bill is drawn or whenever the bill is accepted, depending on the terms and conditions, it will be 3 months plus 3 grace days standard. So from the date of issue, you will add 3 months. 3 months is not in law. 3 months for check, it is there in law. But in bills of exchange promissory note, 3 months is just an example. Even it can be 1 month. So whether it is 1 month, 2 month, 3 month, 30 days, 60 days, 90 days, that is something which is to be agreed between the seller and the buyer. And that needs to be mentioned in the bill of exchange. So how do you calculate the due date for bills of exchange? So whatever is the date of issue of the bill, plus 3 months or 2 months, plus 1 month or 60 days, 30 days, 90 days, whatever it is, plus 3 grace days, you'll get the due date. So therefore, for check, it is very simple, guys. Whatever the check date plus 3 months, that's it. But here, you're supposed to calculate the due date by yourself, depending on what is the terms and conditions in the bill. Already it is? Which majority date? Yeah, due date is called as maturity, but there is a small difference. I'll explain that point. So, in the case of bills of exchange and promissory note, there was no due date as such given. So, whatever the date of issue is there, and whatever the due date you agree, plus 3 grace days. Because in India, we have the habit that on the due date, we don't make the payment. We still ask one more day. So that for that purpose, I said, take 3 days. Take 3 days. But after 3 days, you have to make the payment for sure. So now you need to understand, how do we calculate your due date or the maturity date? Due date is also called as maturity date, but there's a slight difference. I'll explain what is that. Now, when you make the bill of exchange or a promissory note, you can find any one of these terms and conditions. 1, 2, and 3. In the bill, if the term of bill says that the due date will be after date, whenever this word after date is given, it means that you'll calculate the due date or the maturity date, which is issue date plus 3 grace days. You'll take the issue date. With that, you will add, issue date plus 3 month or 2 month plus 3 grace days. Are you able to follow? Issue date plus the period plus 3 grace days. If it is after date. If the term of the bill is after sight. Sight means what? Sight means signing. Which means the due date should be calculated from the date of acceptance. In bills of exchange, what happens? Issuer issues the bill today. Let's suppose that person is in Delhi. So I have to send the document to Delhi. It will take 2-3 days. Then that fellow will sign and send it back. So from the date of signing, only I should calculate the due date. If that is the term and condition, in that case, acceptance date, whatever is the acceptance date, with that you will add 3 months or 2 months and plus add 3 grace days. If it is after sight. If the term of the bill says that you have to make the payment on demand or at sight, which means what? Whenever I'm demanding, when will I demand? See, I have agreed a period of 3 months for you now. So with issue days, I'll add 3 months. So 3 month time I'll give you, but I'll not give you grace days. So issue date plus 3 months, no grace days. Are you able to follow? At sight means after signature. I mean, at sight, on demand, at sight and on demand both are same. After sight means after acceptance. So acceptance date plus the period plus 3 grace days. In case of on demand or at sight, both are same. On demand, if you find the word on demand or if you find the word at sight, both are same. In that case, issue date plus 3 months and no grace days will be added. No grace days will be added. Can we do quickly one question based on this? Here they say that the date which comes after adding the 3 days to the due date is called as date of maturity. So here what they're telling is that issue date or date of issue plus 3 month, 2 month, whatever, that is called as a due date. With this, if you add 3 grace days, it is called as maturity date. Like that the language is given, but at the end, due date and the maturity date means same. So you'll always calculate this only. Whenever they say calculate due date, this only. Whenever they say calculate maturity date, this only. After adding the grace days. So let's do illustration 1 very quickly. What are the due dates of the following instrument? What are the due dates? Look at the language, they're asking the due dates. But at the end, they have calculated the maturity date, which means here due date and maturity date both are same. A bill of exchange dated 12th July 2021. Payable 3 months after date. Which means this. With issue date, add 3 months plus 3 grace days. So what is the date of issue? What is the date of issue? Date of issue is 12 July 2021. Plus the term bill is 3 months. So 3 months. So what is the date you'll get? August, September, October. So can I say 12th October 21 plus 3 grace days. So 13, 14, 15. So 15th October 21 is the due date or the maturity date. 15th October 21 is the due date or the maturity date. Any problem here? Online people, any problem here?
No, sir.
No, sir.
No, sir.
Okay, next question. A promissory note dated 31st March 21. Guys, from your examination point of view, always remember when you work out any practical question, like in the future we'll be doing now, their bills of exchange and promissory note mean same. When I'm doing the practical question, when I do the accounting entries, no, that time please understand both from the examination point of view, both are same. Promissory note dated 31st March 21, payable 90 days after date. So can I say after date means this only? After date. So what is the date, guys? 31st March 21. So date of issue is 31st March 21 plus 90 days. So please calculate, tell me what is the date you're getting. 31/3 plus 90 days. So 31/3 ke baad, next month is April. So April, how many days? 30 days. May, how many days? 30 days. June, how many days? Sorry, May is 31 days. June, how many days? June, 30 days is there. So 30
Yes, sir.
plus 31 is 61. From 90, if I minus 30 days of April, I'll get 60 days. From that, if I minus 31 days of May, I'll get how much? 29. So this is 29th of April, May, June. 29th June. 29th of June 2021 is the due date plus 3 grace days. So June has got 30 days. So 31, 2. So 2nd of July 2021. 2nd of July 2021. So how did we calculate? One more time, let's do it. Days is slight confusing for the people. I'll do it one more time for you, don't worry. See, totally how many days I need to take into consideration? 90 days. 90, see, 31st March is the end of the day, end of the month. So next day is April onwards. Next day onwards, I'll start counting. Okay. So from 90, full April month is gone. So 90 minus 30 days of April. From 90, if I minus 30 days of April, how much is the balance remaining? 60 days. From that, I'll minus 31 days of May. So I'm left with 29 days of June. So 90 days is nothing but 90 days of April, May, and June. From that, if I minus 30 days of April, I'm left with 60 days of May and June. From the 60 days of May and June, if I minus 31 days of May, I'm left with 29 days of June. So 29th day will be the due date. Add 3 grace days, you'll get the maturity date. Now you're able to understand? Rupesh, comfortable? Online people comfortable? 2nd July. So
Yes,
you
sir.
can take this second
Yes,
question
sir.
and mark as important, because whenever it is monthly calculation, it is easy. Days can be a little bit confusing. So you need to do more of practice. Guys, in this entire journey of classes with me, you will mark all the questions in 3 segments. Easy questions, slightly difficult questions, and the most difficult questions. Easy questions, maybe 1 time or 2 times if you work out, more than enough. Slightly difficult question, you need to work out at least 3 to 4 times. And the highest difficult question, you need to at least work out 5 times minimum, so that you get the hold on it. So please start marking right from today. Which questions do you find easy, medium, and difficult? Next is a bill of exchange dated 5th August 2021. Payable 60 days after sight. After sight means what? After acceptance. So from the acceptance date, you need to calculate. So acceptance is on 10th August. So 5th August is what? Issue date. I have sent the document in courier. The opposite person has received after 3-4 days, and on 10th he's signed it. So here, when it is after sight, it is date of acceptance. So what is the date of acceptance? 10th August 21. So 10 August 21 plus how many months? It is saying 60 days plus 60 days. So 60 days of August, September. From that, if I minus, how many days is balance remaining in August? See, August, total 30 days are there. On 10th only bill is signed. So this I'll not
August
take into
31.
consideration. So from this period to this period, I have time to make the payment. So in August month, how many months left? 21 months left. So 21 days, sorry, how much?
31 days, sir.
Yeah. This is August. Next is September. So from 65 minus 21 days of August, I'm left with 39 days of. So here it is August, September, and October. So 60 days of August, September, October. From that, if I minus 21 days of August, I'll get 39 days of September and October. From this, if I minus 30 days of September, I'm left with 9 days of October. So 9th day, 10 August plus 60 days will be equal to 9, 10, 21 plus 3 grace days, which is 10, 11, 12. 12th October 2021 will be your maturity date. 12th October 21 will be your maturity date. Any problem here? Any problem here? Online people, any problem here?
No, sir.
No, sir.
Fourth
point, a bill of exchange dated 30th June 21, payable 3 months after date. I want you to calculate this. Please calculate this. Who's that? Abhi, you talking to me? Okay, so please do this 4th and the 5th question and tell me what answer you're getting. Guys, please work out, have the habit of working out, or else you'll not get the flow. Work out, guys, work out, work out.
Fourth September.
Okay. What do other have to say on that? Right, not right? Yes, you gave answer for the 4th one.
Yes, sir.
What is the answer?
4th September, sir.
4th September. Others, what do you say? Online people, others, what is the answer, guys? Abhi, Ashwin, Kavi, Kavya, Sanjay, Shrikant. My dear Yash, you're wrong.
Calculate in the voice, sir.
It is 30 June, no? So it is month and it is after the date, which means issue date plus 3 months. So 30th June plus 3 months. July, August, September. So 30th September plus 3 grace days. September has got only 30 days. So October 1, 2, 3. So 3rd October is the due date.
Okay, okay, sir.
Next, 5th one, guys. Fifth one. 60 days after date without grace, which means it is on demand or at site. Without grace. So 27th November plus 60 days. Your answer is done.
Sir, 26th January, sir.
26th
Jan.
and 21. So how did you calculate? 60 days, right?
Yes, sir.
So this is November. In
Sir,
November,
it will be
27 days is gone fully. So I'm left with 28, 29, 30, 31. So 4 days of November. So I'll minus 4 days of November. 27, 30 days only. Okay, 3 days in that case. November is got, yeah, 30 days. Sorry. So 27 gone, 28, 29, 30. So 3 days gone from 60 days, 3 days of November gone. So I'm left with 57 days of December and Jan. In that, I'll minus 31 days of December. So I'll be left with 26 days of Jan. And the question is very clearly said that you are not going to add the grace days. So therefore, 26th day of Jan is your 26th Jan is your Republic Day. So if your due date or the maturity date falls. Here, actually speaking, it is only after adding 3 grace days. So let's suppose here it is not 27th of November. Let's suppose here it is 24th of November. So your due date will be what? 23 of Jan plus 3 grace days. So 23 Jan 2021 plus 3 grace days. And if the maturity date is happening on a public holiday means a holiday which already is being known to you. If you know a holiday is already in advance. For example, public holidays you know very well in advance. All the Sundays you know very well in advance. So if the maturity date falls on the known holiday, in that case your due date will be the previous day. So here in this case it will be 25th of Jan. I'll be discussing upon this point in detail in the next chapter. The next chapter, what we're going to do is average due date. In that, I'll be again discussing this point in detail. I'm just going to give you an outline here. If the maturity date or the due date falls on public holiday, like in Jan we have Republic Day, in August we have Independence Day, October to Gandhi Jayanti. If it is a public holiday, or if it is a known holiday like Sunday or a Good Friday, all this is already known. We have the entire year's calendar. If it is on a known day, then previous day will be your due date. But if the date falls on a date which is a sudden holiday, so for example, let's suppose 28th of Jan was the due date, but that day we had a strike and it was a Bharat Bandh. So obviously I did not know this. I could not plan it. So in that case, you will be taking the next day, 29th January as the due date. So if it is a known holiday, the previous day, it is unforeseen or suddenly if there is a holiday, then it is the next day. Is the concept logically clear? Imagine, no. See, 26th of Jan, you very well know it is a holiday. So you plan your payment one day in advance. If 28th January sudden bandh, how will I plan? So extra one day you can ask. That is the concept. Clear with this point? All in people, are you clear with this point?
Yes, sir.
Yes, sir.
Yes, sir.
This is very, very important. Here in your foundation, these kind of questions only will come to you. So warm up is done. Can I go forward? People, can I go forward? Now we'll do the journal entry. Now the bill
Sir,
of
why
expense-
can't we pay in holidays?
in holidays bank is band na baba.
Okay, sir.
So then there will be a problem, no? That's the reason. Now, when the bill of exchange has been issued, which means the seller is selling the goods to the buyer. Along with that, or after a few days, he's got a fear. What if that fellow does not make me the payment? Therefore, you're issuing a bill of exchange. So first transaction is what? First transaction is I'm selling the goods. So when the goods is being sold, what is the journal entry? Debtor to sales. Correct? We have discussed this point already. Now this debtor is unsecured. Unsecured means what? There is no guarantee that this fellow will make the payment. Now, a few days later, you send a bill of exchange. This fellow accepts and gives it back, which means the bill of exchange has been done, finalized. In that case, now can I say that customer is secured now? Until the bill of exchange was accepted, this customer was unsecured. Why I'm saying unsecured? Because this person may not even pay money. Even that possibility was existing. This person would have said that, no, I'm not making the payment. So that risk was there. So as long as the risk of non-payment is there, to that extent, this customer is a debtor. Now, the moment the bill of exchange is being issued and accepted, the same customer becomes a non-risky person. So therefore, I need to cancel this risk. To cancel the debtor, to cancel the asset, or to decrease the asset, I'm supposed to give a credit. So I'm reversing one asset, and in place of that, I'm creating a new asset, and the name is bills receivable. See, we are doing the accounts from the point of view of the seller. So the seller has to receive the money. So for him, it is bills receivable. This bill, from this fellow's point of view, it is bills receivable. And same bill of exchange from the buyer's point of view, it is bills paid. For seller, the invoice is the sales invoice. The same bill for the buyer, it is the purchase invoice. Are you clear with the concept? So first transaction always will be debtor to sale. Then once the bill of exchange is executed, then bills receivable to debtors. So we are creating a new asset. To create or record a new asset, we have to give a debit. And to reverse one asset, it will be credit. So first two entries, do you have any problem? Online people, please keep responding. In the first two entries, do you have any problem?
No, sir.
No, sir.
Now guys, this transaction you're recording on date of sale. This transaction you're recording on date of issue of the bill. Okay. Now on the due date, there are two possibilities. One, that fellow will honor the bill or honor the payer. Honor means what? He'll make the payment. In case if he's making the payment, what will be the entry? We are receiving the money. Cash or bank is real account. Debit what comes in. And if money comes inside my cash in bank balance will increase. To increase asset, I need to give a debit. So cash or bank account, debit. 2. Can I say that asset I need to knock? If debtor is giving the money, what is the entry? Cash to debtor. Same way, here bills receivable, I need to close the account because he's paid the money. I don't need to remember. I debited bills receivable because I wanted to remember that this fellow has to pay me the money. Asset is one way of remembering from whom I should receive money. Liability is one way of remembering to whom I should pay money. So here, though this fellow has paid the money, should I still need to remember? I don't need to remember. So I'll cancel this. So to cancel an asset, I need to give a credit. So cash or bank account debit to bills received. So can we do one question quickly based on this? Illustration 2, guys. On 1st April 2021, you may be wondering that why am I working out this question from the special book? The reason being, the first question of your ICA study material, the illustration 1 of the CA book, is the question based on the retirement of bill and renewal of bill. So that is a little bit advanced concept. So I'm doing a warm-up, and questions can come from this area also from your exams. Since those questions are missing there, I'm doing the questions from the special book. Clear with this point? So we'll get a warm-up thing and then we'll go to the ICA book. So today I think we'll be working out from this book, and probably from next class onwards we'll be doing a workout from the ICA study material. On 1st April 2021, Ram sold goods to Mohan for 50,000 rupees. On the same day, Mohan accepted the bill drawn upon him by Ram at 3 months for 50,000 rupees. Now here the term of bill is not mentioned. In the absence of the information of term of bill, what will be the term of bill? Always this will be the assumption. So please make a note of it. If the question is silent with regard to the term of bill, always the term of the bill will be after date. Please make a note. If the question is silent with regard to the terms of bill, we should always assume the term of bill is after date. Please make a note of it. Guys, in your entire accountancy journey, we'll be making a note of a lot of assumptions. So I suggest all of you have a separate notebook called as a concept notebook, wherein you'll have to note down all your important formats, important formulas, if any, important points to remember, important assumptions, all this if you need to remember, so that 1 day or 2 days before your exam, if you go through these books, it should be easily recollectible. So for that purpose, you need to maintain a separate notebook called as a concept notebook. Now guys, what are they telling? On the due date, the bill was met, which means on the due date, on the maturity date, the bill was honored. Give the journal entries in books of both the parties. So please tell me guys, who is the seller and who is the buyer? Ram is the seller.
Ram.
Yes, and Mohan is the buyer. Seller is also called as drawer. He is also called as maker. He is also called as issuer. He is also called as creditor. He is also called as payee. Pay means don't literally take the Tamil pay. That is different. This is different. Now guys, first transaction is what? On 1st April 2021, the goods were sold. So please ensure that whenever you're writing, proper format of journal is very important. Journal of Ram, debit, credit, date, particulars, LF, everything is important. This rupees is important. So the format is pakka important. If you miss the format, you'll miss the mark. So the first entry is guys on 1st April 2021. I'm recording a sale entry. So for Ram, Mohan is the debtor. Mohan is the debtor. So Mohan debtor account debit to sales. 50,000, 50,000. Being goods sold to Mohan for 50,000. Being goods sold to Mohan for 50,000. Then on April 1, same date, they're telling that the bill was drawn and accepted. The moment bill is accepted, I need to draw the entry for bills. So now I'll reverse the Mohan because Mohan is unsecured debtor. So I need to reverse the asset, and in place of that, a secured asset has been created. To increase or record a new asset, I need to give a debit. To decrease an asset, I need to give a credit. 50,000, 50,000. Now, guys, you have to calculate the due date. Please calculate the due date. Issue date plus 3 months plus 3 grace days. Issue date is how much? 1/4/21 plus 3 months plus 3 grace days. So April, May, June, July. So 1st July. Then 3 grace days. 2nd, 3rd, 4th. So 4th July 21 is your maturity date. On the maturity date, what is happening, guys? You are receiving the money. So debit what comes in. To increase the cash balance, I need to give a debit. And now that the bill amount is paid, I don't need to have the bill. To cancel the bill, I need to give a credit. 50,000. Is it okay? Once you're done with this, let me know, guys. I'll go forward to the next part. Narration is very important. Please practice the narration right from now, or else in exam, if you think that I'll manage, you'll not be able to manage. You'll be thinking and you'll be wasting time. So please practice the narration right from now. Next, we have to record the journal entries in books of Mohan. Mohan is called as drawee. Is also called as. Is called as acceptor. He is also called as payer. He is also called as debtor.
Debtor.
It's very important from the true and false perspective. So here, guys, Mohan is buying the goods. So the first entry will be purchase entry, purchase account debit. Purchase is my expenses. As per modern approach, to record my expenses, I need to give a debit. Guys, if anybody is not sure of what is the rules of debit and credit, please watch the videos what I've sent it to you. If you've not got it, please ask me, I'll send it to you. I've put it on a YouTube channel. So you will get a very clear idea that why are we using modern approach in place of golden rule. Golden rule is not 100% and you cannot crack all the journal entries using the golden rule. That is the reason we are replacing that with a modern approach. Modern approach says that purchase is a expense classification. Expense nature is debit balance. So to increase expense debit, to decrease expense credit. So here purchase is going to increase my expense. So I'm going to debit purchase. And Ram is a creditor. Ram is a creditor. Creditor is a liability. And liability has got what balance? Credit balance. So to increase liability, credit. To decrease liability, debit. So here we are going to increase the liability because we need to remember to pay money to Ram. So therefore I'm going to credit Ram. 50,000, 50,000. On the same date, guys, Ram has accepted the bill. So Ram will reverse. Not Ram accepted. Mohan accepted the bill. So Mohan accepted the bill. So when the bill of exchange is executed, Ram is unsecured to that extent. So we'll reverse the unsecured, and in place of that, bills payable has been created. So this credit, Ram is a creditor. Reversing a liability, I need to give a debit. To decrease the liability, I need to give a debit, and bills payable is a new liability. To create a new liability, I need to give a credit. And on the date of maturity, the bill is paid. So reverse the liability and make the payment. Bills payable to cash. Abigail, Ashwin, Kavi, you are able to follow?
Yes, sir. Yes, sir.
Avyas, Sanjay, Shrikant, Yash, you able to follow?
Yes,
Yes.
sir.
Sir,
Ashwin, I think you've joined in between, if I'm not wrong.
Yes, sir.
Okay, from where did
Just
you
came from my
join?
college. Sir, just came from my college, sir.
You
Sorry.
just joined, is it?
Yes.
Okay,
Yes,
no
sir.
problem. You can continue, but in the beginning part, I've discussed a lot of important points. So in the recorded class, you have to cover it up. Okay,
Okay, sir.
super. Next, guys, Next concept. If you're clear with this, I'll go to the next concept. We are going to discuss 4 cases, guys. In that first case we have discussed, the first case is when the bill is retained by the seller till maturity, which means he's having the bill till the date of maturity and is receiving the money. You saw that case 1. Total 8 cases. 4 cases. 1 when the bill is held till maturity. Then next will be when the bill is being dishonored. So for this case, positive case, and 4 negative cases. Total 8 cases we'll discuss. So in that first case is done. Dishonorment part I'll come in the next class. I'll just complete all the 4 cases when the payment is happening on the maturity date. So I'll be discussing the 4 cases positively. Second case is when the bill is discounted with bank. And here we are going to solve a question where on the maturity date, the bill has been honored. So this is case 2. When bill of exchange is discounted with bank, this means what? Seller sells the goods to the buyer. Okay. Second, seller will issue a bill of exchange to the buyer. In return, bill of exchange is getting accepted and it is being sent to the seller. This is the normal procedure. Now, which means what? Let's suppose the bill of exchange, the term of the bill is 3 months, which means the seller has to wait for 3 months to get the money. Yes or no? Online people tell me yes or no.
Yes, sir.
Now,
Yes,
seller cannot wait till the date of maturity because suddenly from somewhere he's in urgent need of money. Now, if he goes to the buyer and tell that, buyer, I told you that, you can make the payment after 3 months, but somehow I'm urgently in need of money. Can you make the payment today? Will the buyer make the payment? Will the customer make the payment? He'll say, no. Or the other day you only accepted that it's okay that if I give payment after 3 months, I don't have money. So customer will not pay the money. Now seller is in big trouble. Now what to do? So now one facility is being given by the banker. So banker saw an opportunity here. So banker said that, my dear seller was crying outside in the road. So when banker fellow saw, come here, why are you crying? See, I have this bill, sir. I'll get this payment after 3 months, but I'm urgently in need of money. So what to do? I don't know. So I'm crying like a Amul baby. So banker is seeing that opportunity. Let's do one thing. This fellow calls him inside the bank, makes him sit in a nice AC cabin, gives him 1 glass of juice and tells that, I have a problem for your solution. Seller says that, what's it? Tell me. The bill what you have worth 50,000. Okay. Give that bill to me. So the seller is going to give 50,000 worth of bill to the banker. In return, banker is saying that I'll pay you the money. The seller is super happy. Like, okay, come, give money. But banker is telling, wait, the game is not over. I am giving you not full 50,000 rupees. I will give you 49,500. Seller is saying, why 500? Why are you keeping my 500? I'm helping you, right? For that, you have to give something in consideration. No? Because in this world, nothing comes free of cost. So you are in need of money and you're crying, and I'm coming to your rescue to help you out. By that virtue, I will take an advantage of this position and I will try to make money in this opportunity. So you are giving the seller 50,000 rupees worth bill and banker is giving you 49,500. So can I say from banker's pocket, 49,500 is first gone? Then banker will now happily wait till the date of maturity because he is not in need of money. No, he is having a lot of money. So he'll wait till date of maturity. On the date of maturity, this buyer will make the payment to the banker. Now that is the beauty here in the bill of exchange. The last point, remember, this money should be paid to the bearer of the bill. If that wording is there, who is the bearer of the bill here? Banker. So if the terms of the bill says that pay to the bearer of the bill, bank is the bearer of the bill, so he'll get the money. Are you get clear with this point? So banker will go and produce 50,000 worth of bill to buyer. Buyer says that, oh, okay, you are the bearer of the bill, no? Okay, take 50,000. So banker is getting 50,000. Banker is getting 50,000. So he first gave 49,500 and now is receiving 50,000. So in net, how much profit he has made? 500 rupees. So that is the income of bank. This 500 is expense of whom? Seller or buyer? Banker has helped whom? Seller. So seller has taken the advantage. So seller has to suffer the charges. This 500 is called as a discounting charges. The process of giving the bill to the banker and getting the lesser money is called as discounting. This process is called as discounting. And for doing this discounting services, the bank will charge us discounting charges. Clear with this point? Okay. Let's do one question to understand. Illustration 3, guys. Prakash received from Mohan an acceptance for 30,000. Prakash received from Mohan an acceptance for 30,000. Who's the buyer? Who's the seller? Prakash received from Mohan an acceptance. So who is buyer, who is seller? Prakash is seller. Buyer. Seller. 2 seller, 3 buyer. Online people. Prakash received from Mohan an acceptance. Prakash received from Mohan an acceptance. So Prakash is
buyer.
Prakash received from Mohan an acceptance. Who's giving the acceptance? Prakash is giving acceptance or Mohan is giving acceptance? English language. Mohan. Prakash received Mohan's acceptance. So who gives acceptance in case of bills of exchange?
Mohan gives
Buyer.
Buyer. So Mohan is customer. Buyer. Prakash is seller. So seller is given the bill to Mohan. Mohan is accepted. That is how it says that Prakash received from Mohan an acceptance. So Prakash is seller, Mohan is buyer and customer for 30,000 on 1st July 2021. So this is not date of sale. This is the date of bills of exchange being accepted. So will I pass the sale entry? I should not pass. Directly I'll pass the bills of exchange entry. At 3 months, the term of bill is 3 months. Here again, term of bill specifically after date, after side, nothing mentioned. In the absence of the information, it is always after date. Prakash got this acceptance discounted. So this is a case of discounting with bank. So he discounted at 12% per annum at his bank. So what is the discounting charges? 12% per annum. 12% is for 12 months, but we have discounted for 3 months. So I need to proportionately calculate. On the due date, Mohan paid the required amount. Give the journal entries in books of Prakash and Mohan. So let's do it here. So seller is Prakash. Seller is Prakash, buyer is Mohan. So seller has sold goods worth 30,000. 30,000 worth of goods is sold to the customer. Mohan is a customer. So what is the sale entry? Debtor to sale. This entry will happen on the date of sale, but the date of sale is not given in the question. What happened? You can ask me, no problem. Calculate you want. So date of sale, the entry will be debtors to sale. Then sale. No, we're not supposed to write entry for sale. That's what I told here. The entry for sale, why am I writing it here? Because for your knowledge, so that you get to know what is the starting point of the transaction. Now, some people, when I do the entry from here, no, then people say that why debtor is credited? Because always people say that debtor is always debited now. So I'm telling that debtor would have been debited, but in the previous stage. So I'm giving a vision of what is the previous entry. And after that, if you do the bills of exchange entry, you'll get the flow. So this is only to give you an idea how the debtor is being debited here, now the creditor is being credited here. You will start from here only. From here only, the bills of exchange starts. So the question says that on 1st July 2021, the bill was accepted. So when the bill is accepted on July 21, 1st July 2021, we have to reverse the debtor. So Mohan is debtor. We have to reverse him by giving a credit. And in place of that, we need to create an asset called as debtor. 30,000, 30,000. So acceptance is given for 30,000. So this is issue of bill and this is acceptance of bill. Now what happens is that seller is not having the patience to hold the bill till maturity. Therefore is going to the banker and he is transferring the bill of exchange worth 30,000. He's handing over the bill worth 30,000. Now, guys, can I say that when the bill is being handed over, to the bank, from my hand, the asset is going out. Credit what goes out. From my hand, my asset is reducing. So two bills of exchange, 30,000. 30,000 worth of bill is going out. To the extent of 30,000, my asset is coming down. And what will be debit, guys? I am giving this bill of exchange to banker. In return, what is banker giving me? He'll pay me the money. Will he pay the full 30,000? No. From this 30,000, he'll minus the discounting charges and pay the balance. So you need to calculate the discounting charges. So the entry will be bank account debit, discounting charges account debit, two bills of exchange. Now the question is, how do we calculate the discounting charges? You are enjoying this 30,000 for how many months? 3 months. Banker is saying that whoever takes money from me, he has to pay me 12% per annum. If you're enjoying this money for the entire year, pay me 12%. If you're enjoying this money for 3 months, then calculate for 3 months. Therefore, it will be 30,000 into 12 by 100. This will give you the interest for the entire year. But we are enjoying this money only for 3 months, because after the 3rd month, banker is getting the money from my customer. So he has not lent me any money after that period. So 3 by 12. So please calculate and tell me the interest amount. 12% is divided into 4 parts. So 4 3s are 12. So 3 per quarter. So 3 into 3 is 900. So from 30,000, banker will minus 900 and give balance 29,700. So in your bank account, what is the money that is going to come? 29,700. 29.
100.
Yeah, sorry, 100. 900. Is it not the charge to be borne by the seller? Because this discounting was a decision done by the seller. So he has to bear it. What rule says that debit all expense and losses, or expense is a debit balance? To increase expense, I need to give a debit. So this I'm recording expense. So bank account debit 2,900, discounting charges 900, two bills of exchange 30,000 rupees. This is the entry. Any problem here? Bank account debit, discounting charges account debit, two bills received. Guys, this first transaction I'm recording in Prakash book. What is the transaction? Bills receivable to Mohan. This transaction will come into picture because this transaction is happening between whom? The acceptance is happening between Mohan and Prakash. So I will record the entry in Prakash book. I'll record this entry in Mohan books also, correct? Then the next transaction is happening between, the next transaction is discounting transaction. That is happening between seller and the banker. So can I say banker and seller will record? Since we are not preparing the bank's books of accounts, so I'll not do any entry here, but I need to record the entry here. So here the transaction is between these two people. So I need to capture this. Therefore, this entry is coming into picture. Third transaction is on the date of maturity. On the date of maturity, customer is paying to the banker. This transaction is happening between bank and Mohan. Will seller Prakash record this? No. So in the books of seller, I'll have only two entries. One is this, another is this. Any problem? Any problem? Online people?
Clear, sir.
Next, we have to record journal in the books of Mohan, who's your customer. Now, guys, the first transaction is purchase transaction. Purchase transaction is happening between whom? Mohan and Prakash. So the first entry will be what? You don't have to write the entry, but I mean, this entry is not required, only for your knowledge. So purchase account debit to Prakash. And the purchase value is 30,000. The second transaction is the issue of bill transaction, which has been accepted. So only on acceptance, you'll record the entry. Okay. Then on the date of acceptance, this is date of sale. On the date of acceptance, I will reverse the Prakash. I'll reverse Prakash. Prakash account debit to bills payable, 30,000. The next transaction is happening between Prakash and bank. Will Mohan record in his books of accounts? whatever the discounting entry is happening, will Mohan record anything? No, because the transaction is happening between Prakash and bank. Then next transaction is happening. Which transaction is that? Settlement transaction, honoring of bill, which is happening between bank and Mohan. Prakash will not record, Mohan will record. So on the date of maturity, what is happening? He's making the payment, money is going out. So on date of maturity, third entry will be, I'm cancelling the bill because I have made the payment. So I'll debit the liability to bank, 30,000, 30,000. Any problem here? Any problem here? Online people, any problem here? Abhi, clear ka na? Abhi?
Yes, sir.
Clear? Okay. Ashwin, you able to follow?
Yes, sir. Clear, sir.
Kavi?
Yes, sir.
Okay. Kavya?
Yes, sir.
Sanjay?
Yes, sir.
Vikant? Yash? You able to follow?
Yes, sir.
Yes, sir.
I tell you one more thing, guys. All the people those who have not done your 11th and 12th properly, you might find that I'm going a little bit faster. That is the reason I've already asked you to watch the rules of debit credit, journal, and bills of exchange. All those people those who have done all these 3 chapters, you will be able to manage with my pace. Now you understood why I tell that 11th and 12th is important. Because when I do the same question in the 11th standard, this concept I have to explain in 3 classes or maybe 2 classes, which I'm doing in 1 class. So obviously the pace will be faster. So this is why I tell people that if you're not strong with your 11th or 12th, please do that first and then come back and sit here. You'll be able to come and manage with that speed. So all of you are able to follow, guys, online people?
Yes, sir.
Yes, sir.
Yes,
Pace
sir.
is
Yes,
fine.
sir.
Because if I go slower than this, then I cannot complete by October mid the portions. Right? Okay. Next, guys. Now here, there is another concept where what will happen if the bill is being dishonored? So I told you that case I'll discuss tomorrow. In all the 4 cases, first 4 cases will be your honoring of the bill. For same case, what will happen if the dishonorment is done? So that dishonorment will do it tomorrow. Now the third case is, guys, case 3, when the bill of exchange is endorsed in favor of the creditor. Endorsed means what? Transferred. I told you bill of exchange and promissory note comes under Negotiable Instrument Act. Negotiable means transferable. The best part of these 2 documents, I can transfer to somebody else. Now you may ask a question, why? I'll tell you why. So let me take one question for this. Please take illustration 4. It says that Dev owes 10,000 to Krishan. On 1st May 2021, he sent a promissory note for amount payable after 3 months. On 1st June 21, Krishan endorsed the promissory note in favor of Wahid, to whom he owed the like amount. On the due date, Dev paid the amount, passed the entries in all the 3 people, in all the 3 people's books of accounts. My question is, who was Dev? Who was Krishan first? Dev owes the money, which means Dev is supposed to pay the money. So if Dev is supposed to pay money, means he would have purchased something. So can I say Dev is buyer and Krishan is seller? So Dev is buyer, Krishan is seller. On 1st May, he sent the promissory note. Who sent the promissory note? Dev or Krishan? On 1st May, he sent the promissory note. Who sent the promissory note? Dev. Online people?
Dev.
Promissory note is sent by the buyer, customer, that I'll promise to pay you. So Dev sent the promissory note to Krishan for the amount payable after 3 months. So the term of the bill is after date 3 months. So please tell me, what is the due date?
August.
1 May 21 plus 3 months plus 3 grace days. So 1 May, so June, July, August. So 1 August plus 3 grace days. So it is 4th August 2021 is your due date or the maturity date. On 1st June 21, Krishan endorses the promissory note in favor of Wahid. In favor of Wahid. So whatever the bill seller was having, he did not keep the bill with him till the maturity. In fact, he endorsed the bill to the creditor, and that person is called as Wahid. Now, the reason is that, see, if the seller is having the bill, on the maturity date, he has to go to the bank or go to Dev and collect the money. Once he collects the money, he has to go and pay to Wahid. So one he has to go and collect, then he has to go and pay. Double work. So what seller is telling that, Dev, you have to pay me 30,000. And seller has to pay to this creditor or Wahid 30,000. So whatever bill I get, if I just transfer, the job is over. Getting my point? So who is this Wahid? From Wahid, Christian would have purchased the laptop and sold the laptop to customer. So maybe he's a manufacturer, this fellow is the retailer, and this fellow is the customer. Are you able to follow? I'm just giving an idea. That doesn't mean that I took laptop for 30,000 and paid 30,000. I'm telling that this fellow is supposed to pay 30,000. And this fellow has to pay him 30,000. So I need to get from buyer 30,000. I need to pay to the creditor 30,000. So both amount are same. So I thought there is an opportunity. Instead of going and collecting the money and then paying separately, I'll take the bill and give it to the party. Now party will go and collect the money. For me, the headache is over. Or else I have to spend the petrol, go and collect the money from Dev. Then I have to again spend petrol, I have to go and pay the money to the creditor. Instead, once I get the bill, I give it to that fellow, my job is over. And peacefully I can focus on my work. Peacefully I can focus on my work. So therefore, first entry, guys. First entry is what? Selling entry. Then bills of exchange entry. First entry is selling entry. Second transaction is acceptance. So here acceptance is not there because here promissory note has been issued. So here it is issue of promissory note. Then third transaction is seller is transferring this to the creditor. So this is the endorsement. Guys, in case of endorsement, always remember the person who is transferring the bill is called as endorser. And the person to whom the bill has been endorsed or transferred is called as an endorsee. Now in this case, guys, buyer is called as customer. Customer is, this fellow is also a maker. He is also a issuer. He is also a payer. Seller is, okay, for buyer, one more person we missed. He is a debtor. Seller is a creditor. He is a drawee. He is a issuee. Can you call him as a payee? Payee will become why? Because he is receiving the money. And seller is also called as endorser. And this fellow is called as endorsee. Clear with this point? Okay. So third transaction is endorsement. Fourth transaction is what? Wahid is going to Dev and collecting the money. So total 4 transactions. Are you able to understand the order? First is selling of the goods. Second is the issuing of promissory note. Whatever promissory note Christian is having, he endorsed it to Wahid. And on the date of maturity, Wahid will collect money from Dev. So only 4 transactions. First transaction is taking place between Christian and Dev. Can I say both of them will record? So Christian's books of account, let's do it first. Let's do it in Christian's books of account. In the books of Christian. So on the date of sale, the entry will be Dev account debit to sales. You're not supposed to record this, only for information I'm doing it, so that you get a complete flow. Then on the date of issue of the promissory note, either on the date of issue of promissory note or on the date of acceptance of bills of exchange, you need to record the entry. In that, what will happen? Bill of exchange has been created and Dev has been reversed. 30,000, 30,000. So first transaction is happening between Christian and Dev. Second transaction is happening between Christian and Dev. So both Christian will record. Third transaction is happening between Christian and Wahid. So Christian and Wahid will record. In this case, what is happening, guys? In the third case, on the date of endorsement, bill of exchange is being transferred to To whom? Wahid. So bill of exchange is going out of my hand. My asset is reducing. To reduce my asset, bill of exchange 30,000, I'll give a credit. Correct, no? Here I was having asset in my hand. So my asset got increased. Here my asset is going out. So asset decreased. This asset is going out for what? Can I say this is gone to settle my creditor? I'm settling my creditor. I'm reducing my creditor's balance. To reduce my creditor, to reduce my liability, should I give a debit or credit? So here debit will be creditor. So creditor is Wahid. So Wahid account debit 30,000 to bills of exchange. Because already Wahid is in credit. When we made the purchase from Wahid, what entry we passed? Purchase account debit to Wahid. Now how can I cancel this Wahid? By putting in debit. When I make the payment here, what is the mode of payment? Bill of exchange. There's a multiple mode of payment. Cash is a mode of payment. Bank is a mode of payment. Bill of exchange is another mode of payment. So by this payment, I settled the contract. Now the fourth transaction is happening between Wahid and Dev. That is on the date of maturity. On the date of maturity, Wahid is going collecting money from Dev. Will Krishan record that in his books of accounts? Not required. So coming back, the first entry was the sale entry. Second entry was the bill entry. Third entry was the endorsement entry. Okay, not okay. Here they did not record the sale entry because sale entry is not required. They're doing bills of exchange. Bills of exchange happens after sale. Abhi, Ashwin, Kavi are able to follow? Kavya, Sanjay, Yash.
Yes, sir.
Yes, sir.
Yes, sir.
Now next we have to record in books of Dev. Next will be in the books of Dev. So on the date of purchase, Dev is purchasing. No? So on the date of purchase, what will be the entry? Purchase account debit to purchase account debit to Krishan. This is the purchase entry, 30,000, 30,000. This is the first transaction. Happening between K and D. Second transaction, buyer is giving a promissory note. So Dev has to record this. So on date of issuing of the promissory note, I need to reverse Krishan. My creditor has to be reversed, and in place of that, a secured liability has to become. Krishan is an unsecured liability. Bills payable is a secured liability. So Krishan account debit to bills payable, 30,000, 30,000. Now guys, the third transaction happening between Krishan and Wahid. Will Dev record in his books of accounts? Not required. Fourth transaction, that is on the date of maturity, settlement is happening. So date of maturity, what is the date? 4th August 21. On the date of maturity, Dev is settling the liability. So we need to cancel the liability. Bills payable account debit to bills payable account debit to what? To cash or bank.
One.
We are making the payment, boss. 30,000. Now to Wahid will not come because in Dev's books of accounts, Wahid doesn't exist. Wahid is a person who knows Krishan. So I cannot put Wahid. Wahid is a relation between, Wahid has got a relationship with Krishan. Contract of Wahid was with Krishan. Here, Wahid is only going and collecting money. That's it. So Dev doesn't know who Wahid is. Dev doesn't have any person called as Wahid in his books of account. So don't credit Wahid, because if you credit Wahid, unnecessarily opening account in credit. How will you close it? How will you close it? So it will not happen. To bank and finish it off. Wahid will not come. Are you clear with this point? Wahid has got nothing to do with. If you put Wahid here, my question is, if you put bills payable to Wahid, so why this account is opening here? So Wahid will be by bills payable. So in Wahid's account, by bills payable, 30,000 will come. How will you close this? Carried on balance will come here. Brought on balance will come here. So unnecessarily there will be a credit balance. As if we have to pay Wahid in future. So that will go wrong. Whenever you do accounting, guys, you have to think that what entry, if you record now, its impact what will happen in future To that extent, you should have a visibility, because in inter and final, that vision and that visibility of the entries, it's very important. If you're passing an entry, what will be the impact in the future days? That you need to keep in mind and then do it. Is that kind of knowledge you need to have. Right? So I've recorded this entry in the books of Dev. Now we'll record the entries in books of Wahid. In books of Wahid. Guys, the first transaction is happening between Krishan and Dev. Will Wahid record this entry? No. Second transaction is again happening between Krishan and Dev. This also Wahid will not record. But third transaction of endorsement is happening between Wahid and Krishan. Now Wahid will record this. So here what is happening, guys? Can I say on the date of endorsement, Wahid is receiving the bill. So bills is coming in. So bills receivable account debit. For him it is asset. No? I told you bill of exchange is a mode of payment. Payment can happen in form of cash, check, or bill of exchange. So if Wahid is receiving cash, he'll debit cash. If he's receiving check, he will debit bank. If he's receiving bills of exchange, he'll debit bills received. Very simple. To what? From Wahid's point of view, can I say for Wahid, Krishan is a customer. For Wahid is a manufacturer selling goods to Krishan. So can I say from Wahid's point of view, Krishan is a customer, debtor. So now this debtor will get closed. To close the debtor, I need to give a credit. So to Krishan. Before this, the entry of sale Wahid would have recorded. When Wahid sold goods to Krishan, the entry would have been Krishan to sales. To cancel this debit, we gave a credit. Please understand. Before this journal entry, there is a history. In history, we have debit of K. To cancel the debit, we gave a credit. Don't think that this credit is unnecessarily coming now. It is a result of the previous entry. So 30,000. 30,000 and 30,000. Then what happens is the four transactions taking place between Wahid and Dev. On the date of maturity, the bill has been honored, which means what? He's going and giving this bill to Wahid, and in turn, Wahid is giving you money. So cash or bank account debit to bills receivable. I have to close the asset. 30,000, 30,000. Any problem in this? On the date of maturity, you'll pass this entry. Only two entries in books of Wahid, because the third and the fourth transaction is the one which is taking place between the two. Only two transactions. Are you clear with this point? Hello? Online people?
Yes, sir.
Abhi, Ashwin, Kavi, Kavya, Sanjay, Yash, comfortable?
Yes, sir.
Yes, sir.
Super. Last case, guys. I'll take 20 minutes to explain. Can I wind up with this? So 4 cases will be completed. Then tomorrow we'll start those 4 cases afresh from the dishonorment point of view. 15-20 minutes maximum. Manageable? Online people manageable? 15-20 minutes maximum.
Okay.
Yes, sir.
So last concept is, guys, bill sent to bank for collection. My question to all of you: what is the difference between bill being discounted versus bill sent to bank for collection? What is the difference? Both are same or different? Both are different. What happens here? Right. Okay. So let me give you a little bit more flavor. Let me take one question to explain this. You are absolutely right, Samiksha. In the discounting of bill, you get the money immediately. When it is bill sent for collection, you get the money at the later date. But my question is, why this is happening? What is the purpose of this particular concept? Let's do this example, guys. It says that a 2-month bill for 60,000 is drawn by B and Co and accepted by C and Co. So who's the drawer? He's the drawer. Who's the drawee? Who's the customer? C is the customer, that is the buyer, and this fellow is the seller. So it is drawn by B and Co, accepted by C and Co. This is pure case of bills of exchange. Payable at Bank of India. Okay, so it's a 2-month bill. So term of bill is 2 months after date. B and Co gives this bill to their bankers for collection. So the question is, Why is B and Co giving this bill to the banker for collection? The reason is this B and Co says that I am very busy person. On the date of maturity, I'll forget to collect the money on the due date. I'll forget to collect the money from C and Co. So for that person, he's appointing the banker as a PA, where he's telling that, Mr. Banker, I'm giving you this bill. You have to go and get the money from C and Co on the date of maturity. Banker says that, do I look a servant to you? Why will I do this free of cost? B and Co says that, don't do it free of cost. Whatever service you're giving to me, take service charge for that. You take service charge for that. You charge whatever you want to charge. Right? So B and Co feels that on the date of maturity, he will not have time to go and collect the money, or he may forget to go and collect the money. For that purpose, he is appointing bank as an agent, as a representative to do the collection work. That's it. For this work, banker will charge the money that is called as bank charges. On the due date, bill is honored, which means what? The customer has paid the bill to the banker and banker will pay money to us. Show the entries that will pass in the books of B and Co. We'll do the entries in B and Co and C and Co, both. So this is seller B and Co and buyer C and Co. The first transaction is sale transaction or purchase transaction. Then along with that, bill of exchange has been issued. Then bill of exchange has been accepted by the buyer. Then third transaction is bill is sent for collection to the banker. Then banker goes to the customer. When the fourth transaction, banker goes to the customer and collects the money and puts in the bank account of the seller. Okay. So the first transaction, guys, can I say it is happening between seller and the buyer? So we're recording in the entry of B and Co. So in the books of B and Co, in the books of B and Co, date of sale, what will be the entry? C and Co account debit to sales. It is worth 60,000. Are you supposed to record this entry in the exam? No, this is only for your knowledge. Then on the date of acceptance, because it is bills of exchange. In bills of exchange, you'll write this entry on the date of acceptance. If it is promissory note, you'll record this entry in the date of issue. So I'm cancelling C and Co, the unsecured person I'm cancelling. And in place of that, I'm creating a secured person called as bills receivable account. 60,000, 60,000. So this is the second transaction. I recorded the first transaction, second transaction done. Third transaction, the bill is being handed over to the bank. So on the date of bill sent for collection, on the date of bill sent for collection, from my hand, the asset is going out. So what will be the entry? My bills receivable is going out. So two bills receivable. But what will I debit here? Now, bills receivable is an indication to remember that I need to collect money from C and Co. Now the bill is given to bank. Now from whom this money has to come? Bank. You will not put bank here. If you put bank here means the money is already come into our bank account. Bank here means our bank account, not the bank. Bank here means our account in that bank. That is called as bank. So here I cannot put the word bank. Here I'll put a new account called as bill sent for collection. Account debit. So debiting this means now see bills receivable. If you see here, debited here, credited here, which means bills receivable gone. But bills sent for collection is remaining in my books of accounts, which means this will be gone to my balance sheet because I only passed one entry now. So when I open the ledger, in the debit side, the entry will be there. In credit side, there is no entry. So automatically there will be a balance carried down and balance brought down. If the balance brought down is coming on debit side, it is a debit balance. So this will go and sit in your balance sheet on the asset side. This is an indication that this money has to come from the banker. The bill is sent for collection. This is an indication that money has to be received from the banker. That is why we create an account called as bill sent for collection. 60,000 and 60,000. Any problem here? Any problem? On the date of maturity, banker will collect that money and give it to us. So can I say money is coming into my bank account now? On the date of maturity, I am receiving the money. The question is very clearly told that on the due date, the bill is honored, which means on the maturity date, banker will go collect the money from C and Co and deposit in the bank account of the seller. So in my bank account, on the date of maturity, money is being credited. For this, any service charge has been given here? In this question, there is no service charge by the bank, but usually the service charge will come. In case if service charge is coming, bank charges account debit, bank account debit. 2. This bill sent for collection is a debit. Now that money is come, should I not close this? To close this debit, I need to give a credit. So to bill sent for collection, 60,000. Here the charges is 0. In case if charge is there, let's say charges are 1,000 rupees. In case the charge is 1,000 rupees, in that case we will get 59,000 in bank account because 1,000 rupees he will keep for himself. 1,000 rupees he'll keep for himself. BC here means don't think of anything else. Here it means bank charges. Yes, am I right?
Yes, sir.
Yes, sir. So 60,000 is the bill sent for collection. This is the entry, guys. Any problem we have here? Now the
No, sir.
transaction, don't think that the 4 transactions happening between the banker and the buyer. Here, banker, whatever money is collecting, banker is not keeping with himself. He will deposit in our bank account. So it is as good as the 4th entry is happening between banker and us. Or you can say the 4th transaction happening between banker and the buyer. And the 5th transaction is happening between banker and us. So 5 transactions here. Correct, no? So first transaction recorded, second recorded, third recorded, fourth will not record because this is between bank and the buyer. 5th transaction, when the bank receives money, he will pay it to the seller. So 1, 2, 3, 5 we've recorded. Okay, not okay. Now comes in the books of buyer, C and Co. In the books of C and Co, on the date of purchase, the entry will be purchase account debit to B and Co. 60,000, 60,000. First transaction recorded. The next is bills of exchange accepted. So on the date of acceptance, B and Co, I will reverse. And in place of that, I'll create a liability called as bills payable. This is a liability, but this is an unsecured liability. Until the bill is executed, it is unsecured. The moment bill is executed, it becomes secured. So reverse the unsecured and create the secured. 60,000, 60,000. The third transaction is happening between seller and the banker. Will buyer record it? Buyer will not record this. The 4th transaction is happening between bank and the buyer. So on the date of maturity, I am settling the liability. I am closing the liability. So bills payable account debit to bank or to cash, whatever it is. 60,000, 60,000. That's all. 4 transactions happening between the banker and buyer. 5th is happening between banker and the seller. So 5th one will not record. This is the concept of bills sent for collection. 4 cases we have seen, guys. In these 4 cases, we saw what will happen if all the 4 bill are honored. We've seen the 4 cases. Tomorrow we'll see the same 4 cases. What will happen if the bill is dishonored? Right? So we'll discuss this for in initial 1 hour. Then we'll discuss the concept of rebate, that is retiring the bill at a rebate and the renewal of the bill. And relating to this, the question is there from the ICA books. We'll do that and then we'll do the accommodation of bill. So in next 3 classes, that is in next 3 classes or next 6 hours or 7 hours, we'll be done with this chapter. So you can expect 5 marks to 10 marks from this particular chapter. Comfortable? Is this speed fine? Online people, are you comfortable with the pace?
Yes, sir.
Yes, sir.
You're able to understand? I hope my language is very clean and clear in what I'm talking.
Yes, sir.
Yes, sir.
Okay, fantastic. So yes, guys. So that's all from my side for today's class. I'll see you all in which class? Next class. Next class is on tomorrow is what? Thursday? Yeah. So tomorrow, Thursday, we'll be meeting from 5 to 6:30. 5 to 6:30. Right? So guys, I'll see you all tomorrow in tomorrow's class from 5 to 6:30 p.m. Until then, bye-bye. See you. Take care.
Thank you, sir.
Thank you, sir.